For sure, it feels to me like it's a live meeting. As you know, before April 2nd, before we got some uncertainties coming on the policy side, I believed that we had pretty stable, full employment, that inflation's coming down to target.
The Chicago Fed president declaring September a live meeting for the U.S. Central Bank, even as traders trim bets on a rate cut ahead of Jay Powell's much-anticipated speech later today at Jackson Hole. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Chinese semiconductor stocks advancing after a report said Nvidia is halting production of the H20 AI chip it's licensed to sell in China. We'll get insights on the AI superpower struggle with Yardeni Research President Yardeni, and also find out why he thinks the Fed may not cut rates next month. Also ahead, as Foreign Minister Wang Yi wraps up his tour of South and Central Asia, a closer look at the shifting dynamics of China's relations with India and Pakistan. We'll get the view from Beijing with Taihe Institute Senior Fellow Einar Tangen ahead of what's shaping up as a pivotal summit for the Shanghai Cooperation Organization. Let's get straight to our top story. Chip giant Nvidia has reportedly asked its component suppliers to stop production related to its H20 AI chip. The information says the company issued the request after Beijing urged local companies to avoid using the chip that's specifically designed for the Chinese market. Authorities in China had sounded the alarm over alleged security risks after Washington officials said they were considering ways to equip chips with better location tracking capabilities. Nvidia, on its part, has repeatedly denied it built such features into its product.
Government, the Trump administration has approved licenses for us to export H20s to China. Recently, China asked some questions about some security backdoors in our chips. We have made very clear and put to rest that H20 has no security backdoors.
Let's bring in Yardeni, president of Yardeni Research. We know that the news couldn't come at a worse time. I mean, how big a risk is this to tech stocks and the rally we've seen so far?
Well, you know, tech stocks have had a heck of a rally in the United States and other parts of the world, and I think they were overdue for some correction or at least sideways move. And I think it was just waiting for something to happen like this to cause some profit taking. So I'm not too concerned about this. I'd be more concerned if the tech stocks were continuing to melt up. So having some minor correction in the technology names is a good thing. But you know, this is just another example of the fact that there is a trade war going on between the United States and China. We haven't got everything agreed, and it looks as though it's going to be a very fluid situation. You know, we have a kind of a verbal agreement that both sides take positions on and have different spins, and then you know, the next day everything changes. But I think Howard Lutwig, the Commerce Secretary, basically said some things about the chip, the H20 chip, that it was kind of an inferior chip that we were selling China. And I think there was also an issue in China about kind of, you know, getting an inferior product.
So the recent tech sell-off that we've seen is just, what, investors taking money off the table? I mean, we saw Palantir giving up more than $70 billion of market share. I mean, yeah. What, do you buy the dip if you believe in the story?
Well, I don't think you have to buy it right away. I think that if you look at the seasonality in the U.S. stock market, late August, September, you can have sell-offs. They're not known to be particularly good periods for the market, and so I think we're going to see tech get cheaper into September, maybe make a low in October for a year-end rally. So I don't think there's any reason to chase these things. Clearly, this tech rally that we've had was based on very strong earnings for the Magnificent Seven, the cloud providers, as well as the chip providers. And they just got a little bit too close to the sun, kind of like Icarus. When you get too close to the sun in a melt-up, you run the risk of having the wax melt and the wings come off. I don't think it's that serious, but I think we did get too close to the sun here with some of these valuation multiples. I mean, Magnificent Seven at a forward PE of 30. That's awfully high.
Well, the thing is, some say perhaps it is time to buy because when Nvidia is out with its earnings, that could be a catalyst for tech stocks to go higher.
I think a lot of that news is already baked in Nvidia. I think that, good news is anticipated in Nvidia. Bad news is not. And the H20 is one of the reasons that Nvidia has been rallying over the past few weeks. When Huang went to the White House and basically convinced President Trump that it was okay to sell the H20s, and then Trump said, "Okay, we'll let you do that, but we want to cut, we want a commission for that." It looked as though this was going to be another source of revenues and earnings growth for Nvidia. Now the China market is questionable once again. So I don't think that better than expected earnings are necessarily going to push Nvidia much higher, since there's a lot of uncertainty now about what access Nvidia has to the China market.
Ed, when you take a look at long-term returns for these stocks, I mean, how do they look? Because according to our colleague Simon White, he says when you aggregate all together price to book, price to earnings, Q ratio, it shows that long-term the returns are going to be really poor, and it is an indication of a correction to come.
Well, it'll be poor if they don't deliver the earnings growth that the market's anticipating. It is what makes the Magnificent Seven magnificent is that they are, very big companies. They account for something like 30% of the market capitalization of the S&P 500. So that they're really huge, and yet they're generating double-digit earnings growth, which is really quite remarkable. They have a tremendous amount of cash flow. They're using that cash flow to buy smaller businesses that they can leverage up into bigger businesses. And of course, they are investing in AI. And AI may not have an immediate return. $20 per month for millions of people, maybe even more than millions of people, can add up to some serious revenues for these Magnificent Seven. But meanwhile, some of them are also major cloud providers. And as more and more of us use AI, I use it as a research assistant every single day. And as more of us use it, our needs for the cloud are going to increase, and they're going to charge us more for cloud usage.
You talked about how a melt up will be followed by a meltdown. What kind of meltdown are you anticipating?
Well, we just went through that, a version of that. We saw that the S&P 500 at the beginning of the year, February 19th, it had a peak there. At that point, that was a record high. And at that point, the forward PE on the S&P 500 was 22. Back during the tech bubble of 1999, we got up to 25. So we're really kind of getting up there. And meanwhile, for the overall S&P 500, not only did the PE get awfully high at 22, but we again saw the Buffett ratio, which kind of looks at the price to sales ratio, went to an all-time record high. And then we had a correction, and the market didn't stay down for very long. Once it turned around, hit a bottom on April 8th. It was almost a complete V-shaped recovery. And here we are back to the same kind of multiples and valuation levels, which were stretched at the beginning of the year, and they're still stretched now. I think what's changed is investors have come to agree with me that the economy might be more resilient than they had thought. and that we might not have a recession anytime soon, and therefore they're willing to pay these high valuation multiples. But we really need earnings to drive the market higher. And the good news is the first quarter and second quarter earnings for the S&P 500 were incredible. Analysts were expecting something like 3-4% at the beginning of both earnings seasons, and they've come in at low double-digit rates instead. So the earnings picture is great. Earnings in the second quarter, all-time record high for the S&P 500.
You just said that economy is more resilient than thought. You gotta wonder how Jerome Powell thinks about it as we head towards Jackson Hole and that speech, the much anticipated speech that he's about to make. I mean, of course, market pricing in what currently 75 from 90 previously, but you're pricing in way lower than that, 40%. I mean, why?
Yeah. Well, I mean, I'm there's nothing scientific about these probabilities. What is scientific is, we can look at the futures markets, and the futures markets after the July payroll employment report, suddenly we're talking about giving us a reading of 100% likelihood of a rate cut in September, and then it went down to 90% on hotter than expected inflation, and now it's down to 80%. Partly because of today's flash purchasing managers indexes, which were very strong for August for both manufacturing and non-manufacturing, and the price indexes were also very strong. So, the markets are still definitely expecting a rate cut, and the Fed doesn't like to disappoint the market, which is why Powell's speech for Friday morning at 10 o'clock in Wyoming will be so extremely important. Because it will convey to all of us the extent to which he wants to push back against the market expectations. And I think he will push back. I think he'll say, look, there's 2 more inflation readings before the next FOMC meeting. There's a payroll employment number. And I think the consensus turned to the idea that a rate cut is inevitable in September after the payroll numbers came out for July. July was actually not too bad. It was 73,000. And maybe that's all we really need anymore to keep the unemployment rate down. With the border closed, with deportations, instead of needing 125 to 175,000 per month to keep the economy at full employment, we may be at a situation where it's more like 75,000 to 100,000. And I expect 100,000 payroll employment gain when we get the August reading at the beginning of September. And again, I look at that July report, and what I see is something that makes a lot more sense in terms of the revisions. There were downward revisions for May and June with barely any increase in payroll gains. That makes a lot of sense. I mean, there's a lot of uncertainty related to tariffs and DOGE and all these other policies being thrown at us by the administration, that naturally employers said, we're not going to fire anybody, but let's not be in a rush to hire anybody. And then all of a sudden, compared to those downward revisions, July wasn't so bad at 73,000, and 100,000 would be kind of confirmation of my view. So, look, I could be wrong here, but I'm feeling pretty comfortable with the idea that the economy and the labor market are going to continue to surprise us with their resilience.
Right. And everybody's looking at the data because the Fed is looking at the data. The trouble is everybody's interpreting the data differently, right? I mean, we had some people, Al-Arian, for instance, saying that the data has been weak when you take a look at labor in particular, and that the Fed is behind the curve, and that the data that the Fed is looking at is pretty much backdated, wholly backdated, he says.
Well, look, the Fed is data dependent, which means that they're waiting for the next batch of economic indicators to kind of get a handle on where the economy is. So it's true that the current thinking at the Fed is largely determined by the data that's already come out, but they obviously have lost some of their confidence in the strength of the economy, as Mohammed has pointed out, rightly so, because of those that weak July report. I think that kind of threw everybody off in terms of especially the downward revisions. And the president got very mad about it, and he fired the head of the Bureau of Labor Statistics. And look, the data is kind of crummy data. It's about time that we actually spent more money to make it better. I don't think it was politically rigged. I think it just the Bureau of Labor Statistics needs more money to do a better job of collecting the data, so that preliminary data don't turn out to be useless or just way off once the revisions come in. But I think it's all, you're right. I mean, data, even when data comes out, there's a lot of debate about what it's saying. You've got two Fed governors right now who since July have been saying, let's pay no attention to the inflation news, because whatever inflation we get is tariff related and it's transitory. So let's look past inflation and look at the labor market. I look at the labor market, and I'm not. What I see is no layoffs. I don't think anybody can disagree that the layoffs are extremely low. Initial claims confirm that. The Challenger report confirms that. What there also is shouldn't be any disagreement about is that it's taking longer to find a job, and that's why the number of people who are unemployed have gone up. But yet the unemployment rate remains right around 4%, which for all practical purposes is full employment. So I think some of that, one of the reasons it's hard to get a job is because of the uncertainty related to the tariffs, and I think that's abating. And at the same time, I think companies aren't sure what to make of AI and whether they really should be hiring when they might be able to use these technologies to do the job.
And if you are wrong and we see a rate cut in September, would that be a policy error? And if it is, how do you see the bond vigilantes responding to it? Well,
I was wrong again a year ago. At the beginning of last year, I said none and done, and the Fed didn't listen to me. They went ahead and cut by 100 basis points from September 19th to December 19th. But as they started to do that, I warned that the bond vigilantes won't like that because the economy is resilient, and it really wasn't necessary, wasn't warranted. It turned out, so I was wrong about what the Fed would do, but I was right about the reaction of the bond market, more than I expected, actually. The bond yield went up 100 basis points, and mortgage rates went up. And now we've got the Trump administration saying the Fed has got to cut rates dramatically because we need to bring mortgage rates down to revive housing. But we just saw last year that when the Fed did lower rates and it wasn't warranted, the bond market went the other way, and that could happen again this time around. So the Fed could cut on September 17th, 25 basis points, and the bond yield, if we're lucky, will just still stay here at 4.3%, and the mortgage rate will stay at 6.5%. By the way, I don't know if we really want mortgage rates to come down significantly, because if they do, home prices will go to new record highs, and the affordability issue will still be a problem. The Fed may be trying to fix problems that it can't really fix. The problem in housing is a shortage of relatively affordable housing, and a lot of that has to do with regulations. And Congress, I understand, has a bill that's kind of aimed at easing things up in terms of building more affordable housing. So that's important. But the Fed controls the Fed funds rate. They don't control the bond yield. They did when they did quantitative easing, but now they're doing quantitative tightening and reducing their balance sheet.
As you suggested a year ago, when you were wrong, bond vigilantes offloaded treasuries in a huge way. Might we see the extent of that sell-off from the bondholders?
Yeah, I think that the bond market wants to make sure that the Fed and the Treasury are maintaining law and order in the credit markets and the capital markets. They want financial stability. They don't want a great deal of volatility. You know, when you buy a 10-year bond, you're really not looking. Most investors aren't looking to make a killing on capital gains, because that implies that you can also get killed if it goes the other way. You don't want really volatility when you're buying a 10-year bond. And so if the designated sheriff, the Fed, isn't maintaining law and order, the bond vigilantes will come in and do it for them. And again, we saw that last year. You know, I mean, I think that a similar situation could happen now if it turns out that they go ahead and cut rates, and the data turns out to show that that really wasn't warranted.
Right. Ed, still so much uncertainty, no clarity until the Fed moves or not. How do you position for that? How should my portfolio be looking like at this point in time?
Well, we've been recommending overweighting information technology, communication services, industrials, and financials, and they've all done very well. We turned bullish on the stock market in November of 2022, so that was good timing. And, you know, the rally has been awesome. A lot of money has been made. It's probably time to take some profits or kind of rebalance. I mean, right now, the S&P 500, 40% of the market cap of the S&P 500 is information technology and communication services. I mean, it's not a well-balanced index, but that's kind of the nature of the stock market. It kind of shows you where the growth is. Where the juice is, where people are betting that the economy is going to get its growth from. So I'd still stick with those sectors, and I'd look for opportunities to expand in that area. But you know, for anybody who's been listening to me, I've been saying just stay with it. You know, a lot of smart people you know, called the top back in February 19th. They just forgot to call the bottom. And it's, you know, you get whipped out of a bull market like this and you really wind up regretting it. I'm in the kind of the Buffett camp. I'm in the camp with Professor Siegel that, you know, stocks you want to hold on to for a while because they, you know, part of the return is dividends. You want to clip the dividends. You want to reinvest them. And, you know, stocks work out in the long run. It's, you know, it's been fairly consistent for quite a long time.
Right. Ed, hang tight. Ed Yardeni, president of Yardeni Research, is sticking around. Well, still ahead this hour, we'll turn our focus to China's efforts at shoring up its regional alliances in South Asia as it also grapples with a sputtering economy. Keep it here with us. This is Bloomberg. Welcome back to Insight. We're keeping an eye on China chip stocks on the back of Nvidia getting its suppliers to halt those H20 chips meant to head to China. We're seeing a big jump in terms of Huahong Semiconductor, up more than 12% right now. Take a look at Cambricon Technologies, also surging at this point in time. Again, Nvidia instructing its suppliers like Samsung and Amkor to stop production related to that H20 AI chips. Nvidia issuing that orders after Beijing urged local companies to actually use local stocks. Meanwhile, in the broader market, Asian benchmarks looking like this, standing pat, I suppose, waiting for clarity from Jackson Hole in terms of the direction for those cuts, whether or not they're coming come September. Still to come. Taihe Institute Senior Fellow Einar will be joining us to unpack China's geopolitical strategy in Asia as it manages trade tensions with the U.S. Plus, we'll get the market implications with Ed Yardeni. This is Bloomberg.
So this is a very dramatic reset that has happened. Just to put it, that this is not something which has been, this is like a complete pivot in terms of what Modi's been forced to do.
In China, as it makes its pivot more towards the industries of the future, India seems to be a natural place for the Chinese to invest in. They're both part of the global south, even though that's an awkward term, So there are lots of things which make them natural allies.
India will have to be very careful. I think there will be limits to just how much of a détente it could actually enjoy with China, because, as we see, Pakistan continues to be keen to focus on that very special relationship with China.
Some of our guests this week sharing their insights on the warming relationship between India and China and how Pakistan also factors into the equation. China and Pakistan have agreed to strengthen ties following Chinese Foreign Minister Wang Yi's visit to Islamabad. The two nations promised to continue close coordination, saying their friendship is significant for maintaining regional peace and stability. Pakistan's Prime Minister will also meet with Chinese President Xi Jinping at the Shanghai Cooperation Organization Summit in Tianjin later this month. China has been shoring up its regional relationships as it grapples with a still sputtering economy. Economists say its recent push to curb overcapacity is missing a stimulus spark that leaves the economy vulnerable. Joining us now from Beijing is Einar Tangen, Senior Fellow at the Taihe Institute and at Yardeni, President of Yardeni Research, is still with us. Einar, let's start with you. Talk to us about how perhaps China views its priorities, its strategies in South Asia. How is it maneuvering relations with Pakistan and India?
Well, China's actively engaged in these South Asian nations bilaterally and trilaterally. I mean, India, you have to factor in as well. You had a mention of it earlier. You know, the high-level talks with Pakistan and Afghanistan together reflect this desire to have these two countries, which are not on the best of terms, despite originally having a little bit of a honeymoon. They want to pull them together. It's going to be about the SCO and BRI, SCO for security and BRI for economics.
But when it comes to China, one relationship will be prioritized over the other, right? In this case, Pakistan. It goes back a long way, lots of history, a lot to do with military as well.
Yeah, I think that it's a mistake. I mean, China is not active. They're never happy when there's any kind of conflict in their backyard. What they want is stability. That was the whole point of the Shanghai Cooperation Organization, is to pull both India and Pakistan in, have them talk instead of fight. So although they will provide defensive weapons, they also are very, very not keen on this idea that these countries go to any kind of conflict. That ruins trade. It makes things unpredictable, and unpredictability is the most dangerous thing to business.
Ed, let's bring you into this conversation. When you take a look, the implications of geopolitics and markets, it's always there. The risk is always there. But Chinese stocks have done really well. 20% rally since the April sell-off. How much conviction is there for the upside?
Well, I think that there are two kind of global investors when it comes to China. There are those who are willing to invest in China. There are those who like to trade the Chinese stocks. When they look very cheap, they like to get in them. And then there's other investors who've concluded a long time ago that China is not investable, and that if you get a rally, you don't see you don't hear the siren song of moving into China. China's regime pretty much calls the shots on how businesses are conducted, and they can change the rules. And we've seen that occur several times. And the Chinese market, on a longer-term basis, has really been an underperformer. It's underperformed the U.S. It's underperformed India. That doesn't mean that there aren't trading opportunities, and again, it doesn't mean that there aren't even long-term investment opportunities. But I think a lot of global investors have decided not to play there. As a result, you've seen a lot of money go into India, and the Indian stock market really has been extremely hot, and is probably stretched on a valuation basis. But then again, it's also the beneficiary of this trade war between the United States and China. So one would have thought, and until we saw that suddenly Trump is threatening to impose significant tariffs on India. So the whole tariff situation is creating a tremendous amount of turmoil for a lot of countries. And yet, despite that, global stock markets are doing very well. So I don't think it's China is the only game in town. I think the U.S. still has upward momentum going on, and I think there's places to play in the emerging markets that are a good alternative to China if you've concluded a while ago that you don't want to invest in that country because of the lack of rule of law.
You talk about how there are other places to invest in. It's not just emerging markets, but frontier markets as well. If you take a look at Pakistan, for example, it was the best performing stock market last year, second only to Korea this year. We're talking about, returns about 30%. Would you diversify into such markets, or do you, think that the risks are still too high?
Well, I've been doing this for quite a while, and the problem with emerging markets is they go up a lot and then they go down a lot. They tend to be pretty volatile compared to the U.S. market, which has been a fairly steady deliverer of very good returns. European markets have also been kind of frustrating, though of late they've made a big comeback. There's a lot of outperformance by the rest of the world in the first half of this year compared to they outperformed the S&P 500. But of late, it's been a more competitive environment. I think it's more a matter of stock picking, buying stocks in whatever country you want to invest in, but stocks that you really have confidence are going to grow and that they will benefit from a growing economy. India clearly is that. China has the demographic issue. China hasn't really solved its property market problem, and it's still dumping goods in global markets, which is creating trade frictions around the world. And because they're exporting deflation, they're building way too many cars and they're exporting them. So China just isn't at the top of my list of where to invest on a global basis.
And I know when it comes to South Asia, we know that China's maintained a non-interference policy, kind of, Whenever there are tensions, it says, I don't want to be involved. The thing is, when it comes to India and Pakistan, can China actually adopt that stance when, I guess, 80% of Pakistan's weaponry has been procured from China?
Yeah, and about 42% of India's is secured from Russia. I mean, wherever you buy your arms isn't necessarily where your allegiances lie. There is a strong friendship between China and Pakistan, but there's also interest with India. China does not interfere in the internal affairs, but they are concerned about what's happening in Pakistan. The economy is not going well. You have political division. It's not that they're hedging. They're simply saying you need to get your house in order. We're willing to help, but you have to have a plan. But they have a regional plan. This isn't about picking winners. It's not a stock game. This is about how you manage geopolitical relations and create the kind of certainty that is necessary for countries and businesses to get ahead. I don't think that this poo-pooing China is going to be very good, and I'd love to see its stock portfolio at the end of this year.
So I'm wondering how the two sides, India and China, will cooperate, will work together. Where's the potential? Where are the opportunities?
Well, actually, there's a misunderstanding here. This idea that somehow China can stand up for India against the United States and these 50% tariffs, what the Indians see is interference in their elections, Bangladesh color revolution, and Modi really doesn't like it when she says that he settled the conflict between Pakistan and India. So there's a lot more on at stake here. The question for India is, will it turn to BRICS? Because BRICS is the entity that is the heavyweight here in the room. 10 countries representing 40% of the world's GDP, majority of people, land, 4 times as much manufacturing as the United States, and the majority of markets. So if those guys get together and go to Washington, this is what Trump is afraid of. He's made it very clear. He's not a good card player. He said, I'll throw 100% if they do anything about the dollar and 10% for good measure because I don't like them. Then he says, oh, they're nothing. So clearly he's worried about BRICS and the effect that it could have on his plan to dominate the world.
And Ed, how are you, I guess, factoring in the risks from tariffs on the Indian market? I mean, we're potentially looking at 50%.
Yeah. Well, there's Einar's talking about Trump as being a card player, and there's a wild card here, and that is sometime between now and the end of September, it's very, very likely that the appellate court that is considering whether the president actually has the power to impose tariffs the way he's been, I think they're going to rule against him. I think he's going to be suddenly really in trouble from a legal perspective. And I don't think it necessarily will go to the Supreme Court if the appellate court decisively rules that he just doesn't have the constitutional legal authority to do what he's been doing. And when you think about it, it's in a capitalist democracy, nobody should be able to kind of willy-nilly throw tariffs around the way he's been throwing them. It's very disruptive to business. It hurts businesses for no fault of their own. And it's not clear that national security interests are involved in every case. Maybe when it comes to steel and semiconductors and aluminum, you can make the case for tariffs. But to just kind of willy-nilly throw tariffs around as a kind of a political baseball bat to hit countries with and get their attention, that's not such a good idea. It's actually phenomenal how well global stock markets have done despite all of that. But I think that these tariffs are going to be questioned here pretty shortly.
Einar, hang tight. I just have breaking news right now out of Thailand that we've been waiting for. The Thai court, speaking of courts, the Thai court has cleared former Prime Minister Thaksin of royal insult charge. Of course, we're waiting to see whether that verdict would come through. This is the first verdict in a string of legal cases that threatens the Thaksin family's political dominance. Again, the Thai court has cleared former Prime Minister Thaksin Shinawatra of royal insult charge. I mean, of course, if you remember, Thaksin was indicted back in June last year for comments made in an interview in 2015. The Thai Thaksin says he's been acquitted in that royal insult case, so that verdict finally coming through. Ed, you were talking about how, the courts in the U.S. will decide, but until that happens, we've seen how some companies in India have been caught in the crosshairs of those talks between China and India. Case in point, Reliance, Mukesh Ambani. I'm just wondering, does that shape your thinking in, which companies are attractive at this point in time?
Well, I think it doesn't change things because I think a lot of this tariff issue will slowly abate as a major problem for the economy around the world. The global economy has actually held up remarkably well. I think people kind of come to realize that there's nothing you can really know for sure about these tariffs. They can change. The president changes his mind often on these tariffs. And I think with regards to India, there seems to be a little confusion here in terms of the policy. Do we or do we not want, from a geopolitical perspective, to have India on our side? And it doesn't help if that's the case, and it should be the case, then we shouldn't be just willy-nilly throwing these tariffs around at India. And if the whole point of the tariffs is because we don't like that India is buying Russian oil, then why aren't we imposing all of the sanctions that we possibly can impose ourselves on Russia and see if that'll do the trick without getting our trade relationships all confused with people that we want to be on our side in terms of geopolitical alliances.
And we know that when it comes to China, key to its strategy is the Belt and Road. Do you anticipate maybe a scenario where India can engage in either, the Belt and Road or even CPEC for that matter?
Well, not CPEC. I mean, that's a territorial issue and a whole box of worms that is going to be difficult to open up. But in terms of the Belt and Road Initiative, I don't see India joining. They didn't join RCEP. They didn't join TPP. I mean, they're not a joiner. They want to be on their own. But it doesn't mean that they can't cooperate. if you start looking at the AAIB, the Asian Infrastructure Investment Bank, that's based in Beijing, India has been one of the top garners of loans. So it is not about joining the group. It is simply about putting infrastructure as an important part of your development plan. So India is free and able to maneuver. They don't have to join. That is not the issue. The issue is how are they going to deal with its U.S. problem? And while Ed is saying, oh, the U.S. is a good long-term bet, all I'm hearing is Donald Trump causes uncertainty. And a lot of that uncertainty is going to start manifesting as he continues to try to drive the dollar down in this kind of vain hope that he can reindustrialize America and make it competitive globally.
You know, we talk about the evolving strategic relationships alliance in South Asia. I'm wondering whether that can withstand Donald Trump's term. What happens after the 4 years?
Well, I mean,
go ahead, Einar.
I'm sorry. I thought that was addressed to me. 3.5 years more of Trump. We don't know what's going to happen. He might take an authoritarian turn if he, in fact, loses the House and the Senate during the midterms. He's already been, poking at things, sending troops to the border, sending troops to L.A., taking over D.C. These could be a harbinger of things to come. Once again, it's about uncertainty. People don't know what's going to happen. In terms of South Asia, it is being pushed together by the United States. Everything that Trump is doing is to the benefit of China. And it's not, they're not asking for it. In fact, a lot of people here in China say the best gift that the United States has given to China recently is Donald Trump.
The biggest risk, Ed, for the market in South Asia in investing in India?
Well, I think the biggest risk is geopolitical in nature, but that seems to have actually simmered down, certainly in the Middle East. Still a lot of geopolitical risk in terms of Ukraine and Russia. That hasn't gone away. But all in all, I think the risk of tariffs is also abated somewhat, in the sense that everybody's kind of increasingly tuning out the noise and just getting on with their businesses and figuring out how to do things. As Einar said, a lot of the Asian countries that maybe had no particular reason to work more closely together are doing that in reaction to Trump's tariffs. But at the end of the day, I guess one of the things that I would dispute with Einar, I wouldn't dispute it, but I'd say that we give way too much attention to the headlines of Washington's impact on the economy. The fact of the matter is, it's extraordinary how well the U.S. economy and stock market have done despite Washington, whether it's Biden or Trump. Trump will pass on. I don't think we're going to go authoritarian. And I think the U.S. economy is going to continue to prove its extraordinary resilience.
Gentlemen, great conversation there. Einar Tangen, Senior Fellow at Taihe Institute, and Ed Yardeni, President of Yardeni Research. We thank you so much for being with us today. Coming up, former Prime Minister Thaksin Shinawatra has been acquitted in a case of whether he insulted the country's royal family. Details on that next. Keep it here with us. This is Bloomberg. Bangkok, live pictures right there of Thaksin Shinawatra's lawyer, Winyat Chanmontri, speaking to reporters. Of course, he said earlier that the Thai court says that the evidence has been partial and incomplete. Again, the Thai court has acquitted Thaksin Shinawatra of breaking Thailand's lèse majesté law or the royal defamation law. Of course, he was indicted back in June indicted in June last year. Let's get more from Ramzi Al-Rikabi, who's with us. Ramzi, put this in perspective for us.
Hey, so if you remember, and I'm sure you do, Thaksin was fled the country after a coup, and while he was out of the country in around 2015, he gave an interview, and he was accused when he came back in 2023 of having insulted, I think it was the Privy Council, which is related to the crown. Now, the monarch, there are very strict laws, as you mentioned, against insulting or criticizing the crown. It's a revered institution in the country. So it put Thaksin in a very interesting position in contrast to these. The military, who was in control at the time, and accusing him, and basically using these laws against him. Now, he's probably the most high-profile person that was accused of these laws. I think the estimate is about 280 people have been charged with these laws, and under previous governments, particularly in after the coup. There were a lot of concern that it was being overused to go after political opponents, and that's what Thaksin had alleged as well. Now this is is going to be a huge relief for him and for his family, and I think also for folks watching Thailand in terms of worrying about its stability. This political instability, particularly with his daughter, who's the suspended prime minister, who has her own trials to deal with right now, has weighed on investment, has weighed on sentiment. We've seen the Thai stock market be one of the worst performers, the growth outlook looking pretty weak compared to neighbors. And with these U.S. Tariffs from Trump, a lot of analysts have seen, given this political instability, Thailand was probably among the most risk in the region.
You talked about how it's a relief for Thaksin and his family. The thing is, this is only the first one of a string of legal suits against the family, which could bring the family down.
Yeah, they have some issues going on now. His daughter got into a bit of trouble earlier this year. Now, I'm sure you remember there was the border clash with Cambodia. In the midst of that, as it was sort of heating up, she had a conversation directly with Hun Sen, who's basically the leader of, effectively the leader of Cambodia. And for reasons that are still quite oddly unclear, he leaked a recording of this phone conversation in which he was very deferential and sort of even criticized her own military's operations. And that got her in quite some trouble. So at the moment, she's been suspended as the prime minister, and they've actually brought charges against her that she will have her own verdict, I think, a week from today. So next Friday, the Shinra Watchers again are going to be in court, and their power will again be at risk.
Ramzi, thank you so much for that. Bloomberg's Ramzi Al-Rikabi, who leads our Southeast Asia government coverage. Now, before we go, here's a preview of our shows next week. S4 Capital Executive Chairman Martin Sorrell will be joining us live on Monday. We'll discuss his business outlook amid mounting challenges in the advertising industry. Plus, a deep dive into the latest central bank remarks out of Jackson Hole with Robeco, Jalvin Wealth Management, and Fullerton Fund Management. That is it for Inside Brace. For Jackson Hole, this is Bloomberg.